the two contracts with collaborators, stakeholders. Now, in this session, we're actually going to move to more towards people that have started to collaborate in more recently in general, and trying to make use of what is being developed by this C3S contracts. So it's a pleasure now to invite Christoph ELSASSER to provide the first talk on climate services and energy trading. And the floor is yours, Chris. Thanks.
20 minutes.
Yeah, sure. You can switch it on.
So, welcome back. Yeah, my name is Christoph ELSASSER. I'm one of the weather guys on the trading floor of one of the biggest German energy company, and I will focus on energy trading and climate service. So, I apologize for starting with some notes on our company, but I guess that presenting a user perspective is always a good start to start with the user itself. So just some few words on our company. We are the second largest power utility in Germany, and that means that we are active on the full range of or full scale of energy business. We generate power and energy, we trade in, transport and sell also energy. You can see some numbers here. We have a power production which covers around 10% of Germany's net electricity consumption. We still own a nuclear power plant and of course some fossil fuel power plants, but in recent years or recent time we have a high growth in renewable generation underway. At the moment nearly 40% of our power portfolio which we mark at the market is based on or is renewable power. Marketing is trading, and so that is my division here, the trading department. Just to give you an idea what means energy trading, we have about 400,000 of trades per year, and not all of them, but I would say nearly most of them are related to weather, and I would say, or my statement would be that energy trading is really some kind of weather-related decision making. So I want to show you a short example of this kind of weather-related decision making. What you can see here is a kind of screenshot of the power prices last January 2017 on a single day, the 12th of January last year. And this table here is a kind of screenshot what a trader or energy power trader sees on this single day. So some of you may not be aware of the fact that energy trading is not restricted to a short time scale, but nearly covers a time scale from several hours, several days, weeks, months, the next quarters, up to the next years. So energy traders are used to make decisions, weather-related decisions on the full range of weather forecasts. On the one hand, you have the day products, and this is the energy price here, which is related to detailed hourly weather forecasts. The next week may be related to general weather patterns. Then you have sub-seasonal trends in the week after week products. Then you have kind of seasonal impacts, and finally normal assumptions to assess prices of the next year, for example. If you have a closer look at this table here, you can see that the prices are quite different. I didn't pick up the mid of January 2017 by chance. As we have heard this morning by the BCS talk, The winter 2016-2017 has been quite unusual in terms of wind, but also in terms of low hydropower and large energy demand. So you can see that, for example, here the day ahead prices are quite high, and what the trader is asking, or what they deal with, is decisions like, will the cold spell that we see here resemble the February 2012 extreme cold event, and then will the cold and low wind phase last until end of month? They are not sure about that. That's because the week 4 and the week 5 are much cheaper than the week 3, which is covered by the detailed forecasts. And finally, also there are seasonal impacts. Do the low snow reservoir impact hydro production further in the next month, for example? And finally, what is the kind of normal assumption overall if you want to buy or sell the next year? So we have heard that the winter 16 and 17 indeed has been quite unusual in terms of weather, and this is also the case for the power price. Though what you can see here is the power price for German base load on a daily basis from 2012 to 2017. So my example is here, and what you can see is that January last year, 2017, indeed has been the most expensive month for 5 years here. And what an energy trader or power trader really wants to know is, what is the risk that the next winter will resemble this situation in early 17? So, of course, this is nothing new. If you want to assess the risk, you cannot relate on power prices, because weather is not the single influencing factor. We have other factors, like, for example, increase of renewable power production or installed in renewable power. We have trends in fuel prices here. We have increasing coal price, which leads to an increase of power price here in the last 2 years. And then, of course, it's the weather. So if you want to assess the risk that we see another situation like this, for example, in winter 2018-19, you have to make assumptions on the other influencing factors, like installed renewables and fuel prices, and then you have to rely on weather statistics. And having said that, I can say that we really appreciate those tools arising from the projects here. I really don't want to go into any details of the ESEM and the CLIM for Energy tools, because that has been the case in many talks today and will be the case this afternoon. But I just want to show a screenshot to highlight the situation last winter 2016-17. So this is the precipitation event in December 2016. What you can see is here that we exhibited a kind of really dry situation in December or November, December, and also January 17. And with these kind of tools, we are really able to assess what is the aspect of unusual. So what does unusual really mean? So in the left picture here, you can see, for example, the Swiss snowpack, which we derived from or which we downloaded from the ESEM operator. And here you can see the 2016 curve here, which is along the minimum situation for the last 38 years. So these informations are kind of useful for us, and we really appreciate having these tools to assess the question, what is kind of unusual, and what could we expect in the future. So the question is, what about seasonal forecasts? Do we use the seasonal forecasts, or do we use seasonal forecasts at all? And the answer to that question is yes, we do, but to a lesser extent. And the reason for that is that we you all know that the skill of seasonal forecasts in Central Europe is not that good. We heard that before, but I would still expect that there will be a growing interest in the seasonal forecasting because there's a general need for seasonal forecasting in energy hedging. So if you own a power plant, for example, you do usually not sell the energy a day before delivery because this is a kind of a huge financial risk. What you do is you sell or you hedge the energy arising from your power portfolio long time before delivery, years before the delivery. And this kind of hedging relies, of course, on weather statistics and climate. So our wishes of a proper seasonal forecast, a proper sub-seasonal forecast would be, in the ideal case, that the seasonal forecast somewhat links the weather statistics, which is the basement for energy hedging, and the weather forecast, which is the basement for energy delivering in the final state. So my questions to the expert, and we can discuss that later on, is, do you think that seasonal forecasts will in future or still do link the weather statistics with the weather forecasts? I try to do to highlight this in this kind of basic picture here. And would it be possible to continuously adapt normal scenarios with seasonal forecasts and then sub-seasonal forecasting? With the buzzword seasonal to sub-seasonal forecasts, I'm come to the future perspectives or the future prospects finally. We're quite happy that we are able to participate in a new project which is the S2S4E, which kicked off some weeks ago this year. And this project also includes the sub-seasonal timescale into the climate service for energy. And with these last slides here, I want to highlight the market perspective of these seasonal to sub-seasonal timescales. What you can see here in these plots is again the German power price, but this time it's the price for future delivery. So if, for example, here the orange line is the power price for the mean power price in January 2017, and the last point here is the delivered price in the last day of month January 2017, and we start with the price, the future the price which has been traded 70 days before last day of January. So a bit complicated to understand. These are future prices here, what traders thought that January would cost in the end, and we end up here with the finally delivered price. And every of these curves here is one single month in the last 2 years. And what you can see is that there are some months, and that is the reason why I highlighted here the January 17, which is the orange curve. There are some months where the linkage between the seasonal or normal time scale here, I would say 70 days before delivery, and the final delivery is quite good. The sub-seasonal models somehow catch up a trend, and we get a continuous rise of the power price until delivery. But on the other hand, there are some months, and this is the February last year, February 2017, the blue curve here, where you got a kind of trend breaking here early February or late January, and this is a kind of worst case event in our case. So I forget to say these figures are the same. On the one hand, on the left hand, the figures are normalized to the period 70 days before delivery, and the right one here we have normalization to delivery. So this is the same, but with another normalization point. So this is a kind of worst case scenario here, because yeah, what you do is, if you are an energy supplier, energy prices or the power price rises end of January, because weather models indicating that there's more need for energy, so you have to buy to a most costly price, and then finally the weather models change their view, and suddenly you have too much power, and you have to sell it again to a cheaper price, and you can imagine what kind of financial loss is related to this peak here if you have a look at the axis here and multiply the power price, which is in euro per megawatt hours, with millions of megawatt hours which are related to a power portfolio like ours. So there's another picture highlighting the situation in February 2017. We had the subseasonal forecast end of January, the red line here indicating a quite warm January, and then few updates later the subseasonal forecasts completely switched to the other side. This is the subseasonal forecasts early February, and then the final realized temperature here of course had a kind of cold event here, but then finally switched to the warm side end of February. So at the kickoff meeting, some people wondered about a statement of mine, which was that in our case, model consistency sometimes is more important than having a really good forecast error, or really low forecast error. And I would say that this situation kind of highlights this statement, because on the one hand, you may say that this subseasonal forecast end of January wouldn't have been that bad, because it catches up the warming trend here. But if you take in mind that there are several updates between these forecasts here and the final realized temperature, you can say that this kind of erratic subseasonal forecasts is really the worst case scenario in our business. Yeah, so summing up, I would say that, or I would repeat that we are really glad about being a partner here, or having these tools arising from the C3S project. But of course, there's still a lot of work to do, and yeah, we are really keen on the next projects and new developments in the seasonal forecast, but especially in the sub-seasonal time range. Yeah, thanks.